Good afternoon, ladies and gentlemen. A very warm welcome to our special series in Market Guru, where you get to meet the finest brains on the last street, especially at a time when there is immense volatility in the market. Global positions are not all that conducive, and the record high that we saw in September continues to bleed as of now. It's a critical day today, the first day of a fresh Samvat. The Navratras were upon us, and what better time than this to welcome our dear friend Mr. Mihir Vora, the Chief Investment Officer at Trust Mutual Fund, who for the last 3 decades has spent considerable time in managing funds at Birla Sun Life, at Pru ICICI, State Bank of India Mutual Fund, and of course Abu Dhabi Investment Authority. Namaste Mihirji, a very warm welcome and happy Navratras to you.
Happy Navratras to you too, and let's hope for a great new financial year.
Absolutely. With that background in mind, ladies and gentlemen, let's begin conversation. Just a bit of a housekeeping rule. You will see a lot of data that is coming in on Trust Mutual Fund Flexi Cap scheme, which was launched 11 months ago, and Trust Mutual Fund Small Cap scheme, which was launched 4 months ago. Both of them are managed by Mihir, and you will see a lot of data on these two stocks. Broadly, we'll talk about the markets and of course in particular about where investments have gone in as far as these two schemes are concerned. So Mihirji, my first question to you is, we are one day away from what is going to be an imposition of fresh tariffs on the Indian economy by US President Trump. And over the weekend, when the markets were shut at our end because of a local holiday, there has been mayhem in equities. How do you see this development for the Indian equity space, especially at the beginning of a new financial year after a pretty modest one last year?
Yeah, great question, Shell. These are kind of challenging times in terms of volatility. The last half full version of the situation is that India is not really overly dependent on exports. We are one of the least dependent on exports amongst the large economies. If you talk about China, Japan, Taiwan, Korea, all those, and most of the European countries, France, Germany, Spain, they depend a lot on exports. So to that extent, any tariff war kind of a situation, which I don't think is going to happen, but even if that's the situation, India should be amongst the least impacted countries, frankly speaking. So I'm not too worried about that. I would be worried more about the US economy slowing down and dragging the rest of the world along with it, because that can, in general lead to a slowdown. And there is a correlation between US growth and Indian growth. So that slowdown may impact us, not so much the tariff part of it, I would say.
Okay, fair point. And perhaps that's the reason why we have so much of selling that is coming into the IT space. This is directly correlated with the US economy. The more the US grows, the higher is the IT spend, and therefore our own IT exporters work very well. Infosys, TCS, many other companies at multi-month lows. Mihir bhai, how do you see this export basket in India, in particular IT and pharma? How do you see them being impacted by this US potential slowdown and of course the tariff structure?
Sure. So as far as IT is concerned, we have been a bit negative on it all the time, especially the large cap IT companies. And the reason behind is that I think the spike that we saw for a couple of years after COVID was a one-time impact. I don't think that was sustainable. And stocks did run up a lot based on those expectations that the kind of spending that we saw in 21 and 22 will continue going forward, but that's not going to happen. First of all, that was a bunching up of spending because of COVID related issues. You needed people to work from home. So suddenly there was a huge demand for IT infrastructure. There was much more online shopping happening. People are doing much more online gaming, online trading. So a lot of the companies had to facilitate work from home infrastructure and all. So there was a spike in IT spending, but that's done, I think. The next leg of IT spending probably may be linked to AI, but that may not require that kind of software development kind of a thing, because that's more I would say organic in nature. So the the pre-COVID growth rate for most of the large cap IT companies used to be about 5 to 10%, and I think we are back to that path. Unless we try something innovative, which is not in the horizon. So I think IT very clearly we are underweight, and we'll continue to be underweight for a while, especially the large cap companies. We do have some mid cap companies, but those are specific cases where they have a certain set of skills and clientele, and I would say low base to start from because they are small in nature. But in general, we are underweight on the IT sector. Pharma is a little bit trickier in the sense that we are very positive on pharma, especially the CDMO space. There, I think tariffs or not tariffs, no tariffs. The fact remains that China is still the gorilla there. As far as manufacturing of base products are concerned, even CDMO space is concerned. But China is definitely a no-go incrementally for most of the companies. They want to diversify. So I think tariffs or not tariffs, CDMO space should continue to do well. And as far as the generic formulations and APIs are concerned from India, maybe there might be some impact. But again, the point is that we do supply almost half of the globe's formulations as far as the generics are concerned. So to that extent, we should be fine because healthcare is something that they would not like inflation to get touched by because it touches the common man even in the US. So I think we are at a low risk there as far as pharma is concerned.
Okay, fair point. Mihir, what about a view on the current market structure? We've had terrible time between end of September and end of end of February. Those 5 months were very painful for all sorts of indices, whether mid caps, small caps, or large caps. But there was a breather in March. March turned out to be positive for all sorts of stocks. Some of them really shot up dramatically. How do you think the valuation picture is according to Trust Mutual Fund? And are you comfortable with this kind of value that you see in the market? Are you spending from your existing cash? How are you deploying SIPs?
Absolutely. So we are more or less fully invested as we speak. End of March, we are pretty much, maybe 2, 3, 4% cash. That's about it. The view on valuations is very clear. India's valuations versus itself, both for the large cap universe as well as the small cap universe, and India's valuations versus the rest of the world, and India's valuation versus even the US for that matter, are at comfortable levels. In fact, versus the world and the US, we are actually trading at a discount, which is usually not the case. So I think India's relative valuations have come down quite sharply because the fall that we saw from September to January, February was more or less against the rest of the world. You actually saw that some of the European countries make new highs in that period. So our relative valuations versus a lot of the countries has come down dramatically in the last 4, 5 months. That gives a great source of comfort versus other countries. And within ourselves also, given the fact that we are expecting about 10% growth for the Nifty 50 and probably 13, 14% for the broader markets, a valuation of about 18, 19 on a 1 year forward is also very comfortable, both for the large cap as well as the small cap index. In fact, the small cap index is even cheaper because there the earnings growth is expected to be much faster. So I think we don't need to worry too much about valuations anymore. We basically should focus on whether the expected growth is going to get delivered or not. Because if you see downgrades in that, then valuations may come down or earnings may come down. But if we deliver the kind of growth that the market is expecting at this point in time, consensus estimates, I think we are in a very comfortable zone.
Fair point. So, with this background in mind, ladies and gentlemen, let's look at the two schemes that Trust Mutual Fund has most recently come up with. Remember, this is the youngest AMC in India as of now, but Mihir has a 3-decade experience in managing money. So, the portfolio that has come up is really interesting. We'll start with the Flexi Cap fund, which is now 11 months old. The assets under management are sub 900 crores. And what's really interesting is that it's gone up by about 9.5% CAGR in the first 11 months. That's much better than the market, and has increased positions in its top holding, which is HDFC Bank, and added a fresh private sector bank to its portfolio, which is Kotak Mahindra Bank. I know, Mihirji, you will not comment on individual stocks because that is an issue with the regulator. But how do you see the private banking space in terms of valuations, and that both the two stocks that we mentioned have practically not given any positive return for the last 5 years?
Sure. So that's your question had the answer in the sense that you mentioned that a lot of the private banks, especially some of the leading banks, did not give too many good returns in the last 5 years. But the point is that these are good quality banks, and there were certain reasons we bank specific reasons because of which we could not I mean they could not deliver returns. But in general, if you see, the banking sector itself also has underperformed, especially in the last 2 years. We're talking about some of the banks which are underperformed 5 years, but the Nifty Bank Index per se also has underperformed in the last 2 years. And the main reason for it was, the RBI's tightness, the kind of tightness that we saw, in liquidity that has been maintained for a long period of time. And in the last 12 months, RBI also came down on certain unsecured loans and personal loans segment, which was the fastest growing segment. So you had tight liquidity and you had curbs on your fastest growing segment, which is the personal loans and the unsecured loans. So I think banks as well as NBFCs underperformed because of these two reasons, and the rest of the market actually did quite okay till of course September, October. But in general, if you see for 2 years, banks and NBFCs underperformed. Now we have a situation where all these factors are getting unwound. Liquidity is going to be easy. RBI has definitely turned dovish, and the priority is now clearly towards growth compared to inflation. So a dovish RBI plus a general pickup in economic activity, and with the currency also stabilizing, FI flows coming in, I think we should be back to normal credit growth on a low base. And because of the underperformance of 2 years, the valuations also had become quite attractive on a relative. I think banks related to the rest of the markets were at the most attractive valuations for a long period of time. So to that extent, I think the risk return ratio is in favor of banks. In the short term, actually, we would prefer NBFCs to bank, even compared to banks, because of the expectation of rate cut. Because when you cut rates, the short-term rates, which is what the RBI is likely to do, and already done and will continue to do, you get the NBFCs, benefit first because they are wholesale borrowers typically, and wholesale rates, borrowing rates will come down immediately. Whereas a lot of the NBFC book is fixed rate, so you get a better spread in the short term. But ultimately, even banks will catch up, I would say. So I think banks and large NBFCs are positive from the valuation and growth point of view.
Okay. Within the NBFC space, Mihir has stuck to the biggest ones. There's Muthoot Finance in terms of addition, and of course, Shriram Finance as well. Is there any specific reason, Mihirji, why you find large caps a little more attractive at current levels, given the kind of perhaps price action that you could have, better price action that you could have sensed in mid cap and small cap NBFCs and private banks? Why did you prefer large caps within these two sectors over small caps and mid caps?
See, first of all, a lot of the small and mid cap are in the SFB, small finance bank or microfinance space,
Okay.
etc., where we are not that positive yet. Okay, and the point is, if you compare some of the large cap banks, they were available at the same valuation as mid or small cap banks. So then might as well go for large cap ones. Similarly for NBFCs, frankly speaking.
Okay, fair point. That's a very sensible way of looking at the market, and that's indeed the way it is. Even if you look at the small cap fund portfolio, the top holding here is Cholamandalam Finance. So that's how Mihir is thinking in terms of how to deploy money over the financial space, and even sectorally. Both funds are overweight in the BFSI financial space compared with how the overall category average works. There is an interesting addition that I see, which is Divi's. I'm sure you will not comment about how Divi's is doing individually, but what is the view on pharma from now on? Are you focusing on domestics, or do generic exporters still make sense for you?
So our portfolio is more in favor of the CDMO space because we feel that the growth opportunities are far more there. and the issues about margin squeeze, etc., are lesser there, frankly. So we are positive on that space. But healthcare in general is a overweight for us because not only CDMO, but we also have exposure to diagnostics and hospitals also. So all those put together make a decent weightage in the portfolio.
There is this overhanging fear, Mihir, we've seen over the last, I think, 10 odd quarters where the average revenue per operating bed for hospitals has gone up in a fairly decent percentage, and it has also attracted the attention of the government. Do you see any price regulation coming into what hospitals can charge as the upper price for any treatment, any disease? Is that a fear in your mind?
Not really. Even currently, there are certain cities and states where there is a quota for economically weaker sections and all. So these things will keep coming from time to time. But the fundamental issue is that there is a scarcity of good quality healthcare, which is what these hospitals are catering to. And second is that most of them are actually, the well-established ones are now scaling up very rapidly. So in terms of the growth, there are hospitals chains growing at 20%, 30% also. So to that extent, you have a double, benefit of increasing number of rooms as well as improvement in margins as the utilization rate goes up. So I think any regulation, etc., will impact, but that typically we have seen is only in the shorter term. In the longer term, it doesn't matter.
Okay. Mihir, one question that requires your attention is the fact that somewhere in the early part of 2007 and 2008, I'm just talking as both observers in terms of hindsight, there was a flurry of launches from the mid cap and the small cap space, just as there has been in the last 6 months during, say, all of 2024 and to some part of 2025 as well. A lot of quality mid cap funds which are now in the upper quartile of long term returns had been launched in 2007 2008, and they fell by about 25-30% in terms of NAVs. I mean, a 10 rupee NAV became 5.6, 7, 7.5. In hindsight, for all those who held on to those investments and put in SIPs, they've made great money. What is your advice to small cap and mid cap mutual fund investors who have got into funds at higher prices? How should they navigate the next 4 or 5 years?
So first of all, the last 5 years have been great, as superb returns. The last 5 months have been painful, but
Yes.
as I said, the correction has been sharp. The correction has also been because of fundamental reasons, but also because of technical reasons like the relentless FI selling, etc. Uh, as I said, we are expecting the small cap index earnings growth at about anywhere between 15 to 17% for the next couple of years, and valuations are at about 18 to 19 on a 1 year forward basis. So I think the risk return in terms of the overall index is quite good. And within that, of course, there are, I would say, almost 800 stocks to choose from. So building a portfolio of stocks which will give you a decent risk return profile should not be that difficult, and which is what we attempt to do.
Okay, let me just give our viewers an idea about what the small cap fund at Trust Mutual Fund is doing. Uh, it has 717 crores in terms of assets under management. Launch was in November 2004, and the way the markets have worked, at the moment it's available below par, that's below the 10 rupee NAV. But some of the stocks are really, really interesting. Look at the top five. There's Cholamandalam Finance, absolutely top class balance sheet. There is an equally strong balance sheet in the form of Blue Star, which is the second biggest holding. Sagility, this is a newly listed IPO. They deal with the US insurance space, and you have Karur Vyasa Bank and First Source. So these are some of the stock holdings that are there, and the fund is aggressively deploying cash that has come in via the FPO. When you go hunting for a small cap stock, Mihir, what are the 3 or 4 things that you are looking at for the next 2-3 years?
Sure. So we follow a framework of leadership, intangibles, and megatrends, which is the LIM framework, which basically tries to identify characteristics in stocks which are which are likely to be, multi-baggers over a period of time. And we've seen that when these three come together, it creates a bit of magic, I would say, and that's the characteristic of stocks which have a long runway of growth. So our whole investment philosophy is geared around finding stocks which have a long runway of growth. So it's more important for us to figure out whether the runway of growth is for 10 years, 15 years or not, compared to whether the stock will grow earnings by 20% or 25% in the next 2 to 3 years. That is less relevant. I think, and in growth investing, what we have seen, especially in markets like India, the multi-baggers are created when stocks grow their earnings for a long period of time, and which is what we try to identify. Of course, within leadership, you have intangibles and softer aspects like management vision. But for me, the most important is integrity and hunger for growth. If integrity, of course, is a non-negotiable. How you behaved in the past, treated minority shareholders, etc. But the company management and the promoters need to have hunger for growth, because without that nothing happens. So I think the quality of the company, the hunger for growth, and everything all falls in place. Basically, if you have this, then other parts like intangibles, mega trends, etc., will support you.
Okay. Uh, Mihir, just focusing on the trust small cap fund, you have some very fabulous quality multi baggers which have done phenomenally well in the last 20-25 years that I have watched these stocks, in particular Cholamandalam Finance and Blue Star, and you have added into Muthoot and SRF. Now, these are established names. I think all four of them are also at record highs. Are you by any chance chasing momentum, or the two or three points that you mentioned, which is hunger for growth, uh, earnings growth, as well as the long runway for business expansion already built into these stocks?
Sure. The thing about valuations, especially for these kind of stocks, is that, as I said, if you focus on the next 2 to 3 years of growth, they might look optically expensive, right? But when you actually go down and do the business valuation at a higher growth rate for a long period of time, 70 to 80% of the valuation will actually come from the far end profits, not the near term profits. So that's the reason why I keep repeating that it's very important to figure out what the runway of growth is, what the length of the runway of growth is, rather than trying to figure out what the next 2 3 years of profit growth is going to be. So I think some of the stocks that you mentioned might look expensive on a current PE basis, but the market is actually having that confidence in those stocks that these stocks can grow their business and earnings for a very long period of time. That's why they trade a little bit of premium compared to the rest of the market on a current PE basis.
Okay, and surprisingly, Mihirji, I don't see any stocks that represent the sector that you and I are from. The financialization of wealth space. Are you not comfortable with valuations at this point of time for brokerages, for exchanges, for maybe life insurance companies? You have spent a considerable amount of time in one very well-known life insurance company. How do you see this space?
So it's a good that you pointed this out because I would like to spend a couple of minutes on it. So structurally, we are very positive on the capital markets and financialization of savings theme. As you know, we've been discussing it in the past many times. And if you look at our flexi-cap portfolio, from in the first 8 9 months, we were actually quite overweight on the capital markets and these segments that we talked about. So it's broking, asset management, wealth management, insurance, exchanges, depositories, R&D agents. So all those segments we had either in the flexi cap or the small cap portfolio. In January, what we did was we within financials we took a bit of a readjustment, and as we discussed, we added to some of the large banks and the large NBFCs, and we booked some of the profits that we had made in the capital market segment. But I think structurally we would like to get back into that space again. Definitely, it's just that the segment had actually, if you remember, done so well till December that we thought that relatively it makes more sense to be in the larger banks and NBFCs for a period of time. But we would like to really increase our exposure at some point in time in these segments.
Okay, fair point. And one IPO worth mentioning, in fact, you are the third largest holder in Sagility. This is a an Indian, how should I say, a BPO, which looks at the US insurance space, gets a large part of its revenue from insurance, the back end insurance work in US majors, and of course, had a fantastic IPO, was priced phenomenally well. We spoke to the management at Business Today Television, and they were right there in the you know core growth space. How do you look at this specific niche in terms of knowledge providing opportunities out of India?
Sure. So as you said, as I said, in the IT services space, we are not really looking at the large names. We are trying to pick specific, niche companies in the mid cap space, whether it's in the IT services or the BPO KPO kind of space. So some of the stocks that you mentioned fall into the BPO KPO space, where kind of they tick some of the boxes that we are talking about. Whether the target market is large enough, whether it can be exploited for a long period of time, so the runway of growth, and whether the management is good enough for us. So I think this is one of the cases where in this space, for example, servicing of insurance, there is a long runway of growth, and some of the stocks in the portfolio reflect that.
Okay. And Mihir, I would be failing my duty if I not ask you about gold. Record highs, and I have said this to many of our common friends, that here is the Indian housewife winning hands down over all our fund manager friends. She buys very selectively, keeps gold for the longer term, perhaps never to sell, and always comes out to be a winner. Now above $3,200 an ounce. What is your view on gold?
I think till the time you have the issue of debt servicing in the US, the base case will remain that US ultimately has no choice but to print its way out of its problems. So to that extent, I think there is a inflationary environment which is likely to persist. The tariff situation, if it goes through, will also add to inflation. So I think globally people are realizing that they need to hedge against inflation, and gold is a good hedge against inflation. That's why I think structurally gold is in a bull market.
Okay. Any bets where it is headed, and is there a gold ETF coming out of Trust Mutual Fund AMC?
No, we don't have a ETF, no plans for that yet. But I think it's not about absolute levels. It's about the direction. I think the direction is positive as long as the money printing continues and inflation threat continues. If you look at inflation expectations, etc., they are still at highs. So I think all good luck to the Indian housewife. I think they're doing quite well.
Okay. Any level on the Nifty which you don't think will be violated for 2025 on the downside?
So I'd say we are at pretty good levels. The small cap index corrected almost 25%. By the way, the median small cap stock at that point in time was down more than 34%.
Correct.
So we had a solid correction both in the small caps as well as the large cap indices. So if things don't go awry in terms of the the US tariff situation, and of course the China situation as far as war things are concerned, I think we have seen a decent base already built up. So I'm not expecting too much downside on valuations per se, unless fundamentals deteriorate.
Okay, fair point. With that, Mihir, thank you so much for your time, and all the best wishes in deploying excess cash and new SIPs that are coming into Trust Mutual Fund small cap scheme and the flexi cap scheme. Here's hoping that 2025 turns out to be better than 2024. Thank you so much for your time.
Thank you, Chef. Always a pleasure.
Always a pleasure. That, ladies and gentlemen, was Chief Investment Officer Mihir Vora at Trust MF AMC. Broadly, he is positive on private sector banks and NBFCs because of easing liquidity, as of course focus on growth versus inflation by the central bank, and the rise in normal credit growth on a low base effect. So that takes care of NBFCs and private sector schemes. Within the pharma, he is favoring CDMOs, diagnostics and hospital chains, and of course is looking at quality balance sheets where the runway for growth is more than 10 to 15 years. Of course, there is the potential for earnings expansion, and there is hunger for growth, and that's the reason why many of the stocks that he's discussed, which they have added recently in both their newly formed portfolios are trading near record highs or at them. That, ladies and gentlemen, was Mr. Mihir Vora. I hope you enjoyed the conversation as much as I did, but please continue watching Business Today Television. There's a lot that's happening on the other side of the break.
The new education policy debate is heating up. Former Congress President Sonia Gandhi has launched a scathing attack on the BJP-led central government, claiming that